Let's roll. Welcome to STRAT this week, the week of June 5th. Will Woodall, Mike Rarey. Hey, Mike.
Hey, Will.
Summer's officially started here, and what a week we had last week. Across the board, equities. I think the only thing that was down was energy last week, so quite the week. Got a debt deal.
Yeah.
Not sure that was the catalyst or what the catalyst was, but there was a lot of market movement on decent volume. So let's look at the weekly equity returns.
Yeah, the column furthest to the left, you see green across the board. For the first time in quite some time, small caps outperforming large caps. And if you look at particularly the small value, large value areas of the market, a lot of the value gains were really just last Friday, where the non-farm payrolls report came out. That was much better than expected. And so anything sort of economically sensitive, which is more value-oriented, generally speaking, did very well. So a very strong week across equity markets.
All right. What about similar story here in fixed income? What drove the returns here?
Yeah, so a couple things happening. One was getting the debt ceiling deal. What that effectively did was there were some yields at the shorter end of the curve that had been elevated due to fear of default, et cetera. Those came down, so we saw yields come down a little bit from that. But then also the details of the debt ceiling deal showing that less spending, repayment of student loans, these things on net are not good for economic growth going forward.
Right.
And so you saw yields in other places across the curve, longer duration, generally coming down as well. And then we headed into last week with the Fed pricing in perhaps a hike in June. And then now it looks more like they're going to skip in June.
Yeah.
So on net yields came down a little bit there as well.
And we'll get into what a skip is and what it means, et cetera. But let's take a quick look at the alts bucket.
Alts, you see global REITs performing very well. They generally rally alongside equity markets, and they're economically sensitive, so no surprises there. And then in commodities space, gains across the board. A lot of noise here. Many of these areas within the commodities market were beaten down quite a bit. The only negative returning area was energy, and then, of course, it was then announced over the weekend that we're going to get more production cuts from OPEC. So not a fan of lower energy prices.
So it's interesting. OPEC's thinking about cutting production. That's usually recessionary. That definitely has recessionary tone. So, but let's move to the Fed and talk about this new idea of the skip that's been coming up. And I guess it's not new in terms of a Fed option, but it's new in the cycle.
Right.
Pause. You've got the pause. You've got the hike. You've got the cut.
Yeah.
Now we've got the skip.
Yeah, and the pivot. Don't forget the pivot.
And the pivot.
Yeah, so now we have the skip. So what that basically implies is this is the Fed funds futures curve. The Fed is meeting next week, and they could perhaps skip hiking this meeting. Very important because that does not mean that they would be unable to hike at the next meeting in July. They basically want to take a meeting off from hiking to look at more data and see how the tightening of credit conditions we've seen in the banking system since March starts to bleed through to the economic data, just so they can quantify what's the tightening impact of that before they tighten monetary conditions further. So very important signaling. Now we're in the quiet period, so we're not going to hear anything else. So basically, Philip Jefferson, who's the vice chair nominee, had sort of the last word on the topic, and he advocated for the skip. So we are calling him the skipper.
Perfect. I love it. And a skip is really nothing more than a wait and see. It's not a pause. It's not a reversal. It's a wait and see. And it's something newer. We don't really have a lot of historical skips in these hiking cycles. But what would this do to markets if they decide? How would markets interpret a skip?
Yeah. the press conference is going to be very important because you can see what the market is now expecting is, hey, I don't really know what's going to happen next meeting. So once again, if you look at the Fed funds futures curve, it's like a 30% chance of a 25 basis point hike. So it's not a lot, but at least one more hike is still priced in for the year. So it might come in July, it might come in September, we're not sure. So basically this will be a live meeting and the press conference will be very important. They could skip dovishly, they could skip hawkishly.
Yeah.
You know, we'll ultimately see. The big thing will be the next few inflation prints and jobs data, and the jobs data coming through. If those continue to come through stronger than expected, then this skip turns into, hey, we're skipping and we're going to have to hike even higher. That would ultimately be bad. If the jobs data starts to come in much weaker, and now they're skipping when they should have been cutting, that could be bad. So once again, it's a narrow path.
Yeah. We'll see. It'll be interesting to see when a skip, when a skip becomes a pause.
Yeah.
Like we'll see a lot of data coming in. I think they've hiked enough where it makes sense to sort of stop for a while and see the effects run through, because we're seeing a lot of things underneath the surface that don't look as good as the markets are telling you they are. So there's not much updates to the framework this week, but still, let's just run through it real quick. Liquidity first.
Yeah, if you want to price a Fed skip into liquidity, there it is. It's nothing. So, you know, all this debate about are they going to skip, are they going to hike a quarter of a percentage point in terms of money supply growth and our forecast and liquidity, which matters for the economy, et cetera, it means absolutely nothing. So it's still going to be a very difficult liquidity environment for at least the next 12 months. Very small improvement in overall money supply growth 12 months out.
Yeah. And maybe just in terms of, I don't know if we're going to get to this later, but in terms of skipping, now that we have a debt deal and we've got a lot of treasury issuance, that's tightening in itself, right?
Right.
So how will that play together with this skip potentially?
Yeah, that's one more thing that don't think the Fed would say it, right? Because they're fully independent, but they are aware, you know, now it seems like most people are aware, that if Janet Yellen goes and issues $1 trillion worth of Treasury bills, that is going to have the same monetary tightening impact as 1 or 2 rate hikes. And so now that we have this debt ceiling deal, and that's thankfully behind us, now you have, you know, Janet Yellen's quantitative tightening that she's about to embark on in order to rebuild the Treasury general account. So that's another thing that the skip gives you, is time to see how that plays out. Because if all this deluge of Treasury issuance that's about to happen, if anybody who's currently in reverse repo decides to let those roll and buy the Treasuries, then there's almost no net liquidity impact.
Right.
But if everybody in reverse repo stays put and you have to have new buyers of all this Treasury bill issuance, that's going to be a problem.
Yeah.
In terms of economic growth, financial conditions, liquidity, et cetera. So that's what the skip does for you.
Yeah, and you're seeing 1 year, 6 month, 9 month bills, you know, well over 5%. So there's going to be, I think, an appetite for those bills. So we'll see how it plays out. Let's move on to inflation updates.
Yeah, no real data updates in terms of our inflation model last week. So just reiterating what we're seeing 12 months out, still looking at core CPI running near 4%, roughly twice the Fed's target. So, you know, their forecast models are saying something different. That would be interesting, but ours would suggest you still need to be hiking. You shouldn't be skipping. If a year out, inflation is twice your target, you should be hiking. And then if you think, well, a skip doesn't mean you're going to stop hiking, it means you're going to pause for a meeting. Well, if you need to hike, it's always better to do it sooner rather than later. Hikes should be front-loaded. Late hikes are less impactful. You know, we've seen the lessons of the 70s. Jim Bullard, who spoke earlier is in favor of, hey, let's not get cute with this pause or this skip.
Right.
Fact of the matter is inflation is not coming down fast enough. if we need to continue to hike, it is always better to front load the hikes.
Yeah, I think he was
And do them
talking
sooner.
potentially about doing 50 basis points
Right.
in June to just, like you said, front load it, and we can always reverse it if we have to. But
Yeah, exactly. And all this language about the pause and the skip, once again, we show it doesn't matter for liquidity. It's nuance that, traders and market timers can try to make some sense of.
Yeah.
A reason to buy the 8 largest stocks in the S&P 500, I guess.
All right, economic growth, no big changes here. Still about flat line for the year.
Yeah, still flat line over the next 12 months. We are seeing, in terms of economic surprise indices, some surprise here, positive surprise, which is nice in Q2. A lot of that has been coming from housing market. So don't know if that really has legs given the prevailing mortgage rate environment, especially if we keep hiking and banks are tightening.
Yeah.
So
it seems like inventory is coming off the market pretty rapidly.
Yeah.
Okay, let's take a look at the next graph, which is talks about the jobs. So the whole weekend, I got questions from people about how did
you
we
get
add
questions on the weekend.
How did we add this many jobs and the unemployment rate went up?
Yeah.
So let's talk about that and show this graphic we have here.
Yes, the monthly non-farm payrolls report, aka the establishment survey, showed on a seasonally adjusted basis 339,000 jobs were added during May. That was great. The other thing that it showed was the past 2 months were revised higher. If you look at the other statistical nuances around that survey, things like the net birth death business forecast and how much that contributed, that was insignificant. So by and large, that was a clean non-farm payrolls report. Jobs added in virtually every sector. But then the unemployment rate goes from 3.4 to 3.7.
Yeah, this is a big move.
That's a pretty big move.
Yeah.
And most people, they would just look at that and they would say, well, then clearly labor force participation went up. People entered the labor force because we added jobs.
Yep.
So if the unemployment rate goes up, there were just more people now looking for jobs. That's positive, but that wasn't the case. The labor force basically was flat month over month. What actually happened was the household survey, which is used to calculate the unemployment rate, showed that 310,000 jobs or so were lost during the month of May on a seasonally adjusted basis.
Right.
So you think, how does this happen? Does this ever happen? What does this mean? All these questions. There are survey differences between the two surveys. The establishment survey surveys businesses. They say who was on your payroll. So a couple things can happen there. If you have 2 jobs, you get double counted, right? You're on 2 payrolls. If you're on unpaid leave, you still have a job, but you didn't get a payroll during the survey period, you're not counted.
You're not counted.
And then versus the household survey, and also the establishment survey is non-farm. It also doesn't include self-employed people. The household survey is different. You can only get counted once. If you're on unpaid leave, you would get counted here. You're not counted in the establishment survey. If you're self-employed, you get counted. So there are statistical differences here that lead to some differences in numbers. But ultimately what happens is these 2 measures of employment diverge and come back. So what we'll be watching for here is, one of 2 things is going to happen. Either the establishment survey over the next few months is going to catch down to what the household survey is saying, or same thing could happen that happened last October, which was the household survey caught up to the establishment survey and the labor market just continued to grow. So it's noteworthy. It's definitely something we'll continue watching. Don't think it's enough to say that the Fed should cut or would change the path of monetary policy or anything like that before the Fed meeting next week.
Yeah. So on the whole, how would you rate the jobs report from that we got in May?
Yeah. So which one, the establishment or the household?
I mean, just the jobs
picture
environment right now.
Yeah. I think everybody who's been trying to hire people would say something like the labor market is clearly softening.
Yeah.
If I'm looking to hire people, it's easier. I did have to lay some people off. They seem to be getting other jobs. Weekly initial jobless claims are moving up. So, back in October, if you say who's right, the last time we had this divergence, establishment or household survey, it'd be a tougher call. Now, if you're going to say who's right, you'd probably lean more on the household survey. We're definitely seeing some softening, and it takes a while. There are revisions to the establishment survey like crazy, so we'll see what happens.
Yeah, should be an interesting weekly jobless claims sequence through June.
Yeah.
All right, quick update on a recession indicator. Small change in the very near term, right?
There's green. There's green on the board. For the first time in basically a year, the right now indicator dipped below the 15% threshold that would make it orange or yellow or goldenrod, whatever color we use, and it flipped to green. So doesn't really change the recession probability 6 months out, but if we look through the actual indicators, why did the right now move down? One of the biggest impacts is the S&P 500 as a percentage of the 52-week high. It's basically at its 52-week high.
Right.
Why did that happen? Well, because you think about where the S&P was last June, it was pretty low.
Mm-hmm.
So, 12 months out, you're basically near your 52-week high. That 52-week high is in the 4,300s, and it's from the very end of that late summer bear market rally we had.
Right.
That was eventually just totally squashed in August. So that's decreased the right now probability. And then the other thing you'll see for those of us who are staying with us every week, within the short indicator bucket, initial jobless claims has replaced the SOM recession indicator. That had virtually no impact on the numbers week over week,
right,
but something we'll be watching going forward. The rule is once the 12-week average of weekly initial jobless claims is 20% or higher above the 52-week low, that has preceded every recession since World War II, something like that. So we're at 18.2%. It would really just take one or two weekly jobless claims numbers near 300,000 for that to trigger.
Yeah. And so it's interesting. We'll throw up the next chart. The S&P's behavior around recessions.
Mm-hmm.
And it looks like we're setting up for a very similar outcome here. So take us through what we're illustrating.
Yeah, everybody who thinks markets are efficient, this would be the counter to that. But basically what it shows is you take the S&P 500 1 year out from each of the past 7 recessions. And that dashed line in the middle of the page is the actual Ember recession date. So you say, well, does the S&P 500 sort of sniff out the pending recession? And the answer is no, or at least not with a lot of time to spare.
Right.
This is why it's in our short indicator bucket.
Yeah.
So that's the average of the S&P 500 price behavior coming into the last 7 recessions is that dark blue line. You can see roughly 30 days out, it's almost at 52-week highs. On average, 30 days out from a recession, the S&P 500 is at about 95% of its 52-week high. So,
which is kind of where we are now.
Right, which is, near where we are now. So, we totally understand that there are some days where you wake up and you look at the financial media and the news coverage, and it's like there's absolutely nothing wrong, right? And the S&P 500, if it's this high, how could anything be happening? But history always suggests that just because the S&P 500 is high right now, it does not mean that a recession is not just around the corner.
Right. Yeah, absolutely.
So
that's a great graphic. It's a lot to consume here, but it really does illustrate that the recessions come quickly relative to the price action.
Yeah, they always seem to surprise equity investors.
Yeah.
Every time.
Yeah.
So.
All right, well, that's a good wrap up for the week. We'll leave it there. Thanks for tuning in. If you have any questions, reach out to us or contact someone in the private wealth team, and we'll be back next week.